All right, glad to have you back. Let's start our conversation this afternoon with Professor Uwaleke, the president of the Capital Markets Academics, who joins me live from our studio in Abuja. Prof, good afternoon and thank you for joining the program this afternoon.
Thank you so much. Very good afternoon to you, Tolu.
Yeah, Prof, I think there's been a bit of delay. I don't know if you agree with me, but first let me ask you, what do you think are the fundamentals, or what are those things that we should consider as we look ahead to the first MPC meeting for the year 2025? I checked before I came in here. It should hold now at about February 26th and 27th.
Yeah, thanks so much. As you rightly noted, the MPC's first meeting is usually in January.
Yes.
And that's also the practice by many central banks. Of course, you know that the Federal Reserve of the U.S. held their Federal Open Market Committee meeting in January. So most central banks usually have that in January. So for us in Nigeria, it's also meant to be in January. Of course, 6 times in a year. But that of this year has been shifted to February 17th, I understand, for obvious reasons. Obvious reason in the sense that we are expecting any moment that the rebased CPI will be out. The initial impression we had was that it was going to be out by the end of January, but it's still being expected. And of course, you know that one of the things that they try to address at the MPC meeting is to see how the members can use the traditional tools, monetary policy tools, to address the inflation challenge. That's talking about the monetary policy rates, talking about the cash reserve requirements, and talking about the liquidity ratio. Okay, usually at the end of each MPC meeting, the members are expected to come up with decisions regarding these rates. So if the rates are meant to address inflation, for example, and you don't yet have that inflation number, you would of course want to wait until you have the new inflation number before you can be in the best position to address that. So we are expecting, the expectation is that by the time the rebased CPI, that's the Consumer Price Index, which measures inflation, by the time the new figure is out, it will put the members of MPC in a better position to now, make that decision. So to me, that's what has caused the delay. And generally, of course, the expectation is that by the time we have the new figure, the inflation rate that as at December stood at over 34%, we are likely to see a figure that is much lower than that figure. And that's because of the new methodology the MBS is adopting, which it's in an attempt to also get the inflation figures, reflect, current reality. So that is what is going to inform the decisions by the MPC. So we are expecting that the inflation rate is likely to be lower. And you also know that the MBS is also working to rebase the GDP. So it's not only the CPI, they're also rebasing the GDP. And GDP is also a consideration in, reaching decisions regarding monetary policy, because you also, the primary aim is for monetary stability, monetary and price stability. But of course, the MPC members will also have an eye on output, on what happens to GDP. And that's why they also need to wait until the rebased GDP figure is out to be able to make informed decision. And the expectation, again, just as I mentioned in the case of CPI, we expect the inflation rate to be lower, the new figure to come up with a lower number. That of GDP, we're expecting that because of the methodology, again, they are adopting, and because of the fact that they are also expanding the number of items that will come in this time, number of products that will come in this time, we expect to have a higher GDP number. So these are the considerations we are likely to see by the MPC members, going forward.
Prof, there is this concern that has been raised by many, and even now is coming from one of the members of the committee, and that's talking about is saying excessive government spending as a major obstacle to effective monetary policy implementation in Nigeria. How would you react to this?
Of course, the member that gave that opinion is very correct. Most of the time, MPC is challenged by, if you like, what some have described as fiscal surprises, and that's speaking to the, the huge spending that, of course, goes to complicate the issue of money supply. That's what usually comes from the fiscal side, and that's the more reason this coordination is important. It's very important for the fiscal side to also take into cognizance the effect of fiscal actions again on monetary aggregates, particularly money supply. Of course, you also know that the unification of exchange rates. One of the things that unification of exchange rates, one of the things they did was to also increase the allocations that the FG and the subnationals, used to have. So these things have been increased now, such that every month we hear they share over, ₦1 trillion. In the past, it used to be, on the average of 650 billion. I recall at the time I was finance commissioner, the average we were sharing then was around 550, 650 billion. That's talking about the FAC, okay, both the FG and the subnational. So today we hear figures in the region of over 1 trillion, partly on account of the devaluation of the naira that accompanied the unification of exchange rate. So in a sense, you now have too much money out there, which, as I said, is not usually in the interest of monetary policy management, because that also complicates things for the central bank. So yes, the more money that's now in the hands of the FG and the subnationals should be well applied. Of course, when you apply them to productive uses, when you apply them to capital projects, they don't ordinarily fuel inflation. But when such money is spent on consumption, when it is spent on recurrent, that's where the central banks, gets concerned. And that's why the central banks, will always advise that in terms of spending, there has to be, the government has to pay more attention to the productive elements that don't, complicate the inflation figure. So to that extent, I think is very correct. And remember too that there is this issue of borrowing. Again, when the government is always borrowing, particularly from the domestic market, what happens is that it drives up interest rates. But as far as I'm concerned, borrowing is not the issue. Borrowing is not bad in itself. But again, when we borrow, what do we use the money for? If we borrow and we apply it properly, we apply it to self-liquidating projects in particular, you won't have the issue of, again, high debt burden. You won't have the issue of again, inflation. Because, by the way, you are borrowing to produce. If you produce, if you have increased output, for example, particularly food output, the rate of inflation in this country today will be lower. Okay, the part of why we have the pressure we're having now in the area of prices, it has to do with the output, food output. Food inflation is where the pressure point is. And that's why if you check the National Bureau of Statistics data, disaggregated according to states, you will find that in some states like Sokoto, food inflation, according to the last report, was as high as it was over 50%. So if we can increase food output, okay, spend on agriculture and then increase food output, you will expect that it will also help to bring down inflation. So the trouble is when we get this money and we use it to chase the scarce forex, okay? If part of the money is used to go and chase dollars, for example, to mop up dollars, of course, what do you expect? Exchange rates will continue to go high. And if exchange rate goes high, cost of imports, of course, cost of imported items will rise. And that also fits into inflation. So that is the worry of the central bank when money out there is not being applied to productive purposes.
As much as we see some strong growth headwinds, Prof, I want to ask you, even as we move ahead to the meeting for 16th and 17th, yes, that is next week, or upper week, I beg your pardon. Many would say that there might still be a bit of tightening moving forward. Well, what do you think, or what do you expect, considering the growth headwinds that we have seen? That's my question.
Yes, I agree. The downside risks are there. Part of the downside risk is even what has been happening recently, the increase in tariff, telecom tariffs, the increase in electricity tariff, and the increase in port charges. We had just 15% MPA, increase in port charges. So all these are downside risks to inflation, no doubt. They are likely to further contribute to increasing the inflation rate. But again, when you look at it holistically, I don't expect, if I were a member of the MPC, I wouldn't be talking about further tightening. We are already operating in a very high interest rate environment. We need to, ramp up outputs, and to be able to do that, we need a low interest rate environment. If you take the case of sub-Saharan Africa, our policy rate is about the highest at 27.5%, followed by maybe Ghana, 27%. So we already have a high interest rate environment. The MPR is not only high at 27.5, you also have high cash reserve requirements of, at 50%. Okay, so the two combine to ensure that, the cost of credit, is quite high in Nigeria. So I think, yes, I understand why the central bank in the last, particularly since February last year, embarked on an aggressive monetary policy stance. Between February and November, they hiked monetary policy rate by as much as 875 basis points. So that's on the high side. But again, as I said, I understand why that was done because of course, the huge injections we had in the economy, the after fallout of the huge ways and means again that the central bank needed to contend with. But I think it is time we halt. Central bank matched the brakes on policy rate hikes. I expect that by the time they meet on the 17th, they will be holding the rates. They wouldn't be increasing, and that's because again the new inflation rates that we are likely to see, I mentioned it is likely to be lower. So if we have lower inflation figure, and we're also beginning to hear that even the Naira has been appreciating lately in the forex markets, even in the parallel market, Naira has been appreciating. So if we have exchange rate coming down, as it is doing now, and you have lower inflation rates, and you also have central bank still has, in terms of reserves, relatively, strong reserves to be able to finance many months of imports. We hear, as the last time I checked, the external reserves was around $39.7 billion. So with all of this, okay, I think that the MPC will look at them and then decide to hold the rates with a plan. Okay, by way of future guidance, plan to also maybe take on an accommodative monetary policy stance, in the future. Now, the central bank will be doing that, of course, without also considering global factors, global events. Today, we have seen Donald Trump release 42 executive orders. A number of those executive orders are also going to have implications for Nigeria. If you take a look at the energy, what he said about energy emergency in the U.S., the order on, easing regulations on oil and gas, of course, that will mean, more focus on fossil fuel. That will also lead to increase the supply of fuel. So when you have increased supply of fuel, oil in the world, globally, that will impact prices. So we are likely to see, if all of that, go through, we are likely to see lower oil prices, in the medium to long term, particularly if America, starts ramping up, oil production. And there is also the issue of the executive orders to do with immigration, okay, and then, birthright, citizenship, for example, the strict immigration policies of the U.S. Of course, we also know how that will impact Nigeria, especially in terms of diaspora remittances. So we're also likely to see reduced diaspora remittances as a result of the strict, immigration policies that Donald Trump likely to implement. And of course, there is also the issue of tariffs. Tariffs, on China, Mexico, Canada. Okay, that may also have the impact of even increasing inflation rates in the U.S. Currently, inflation rate in the U.S. is around 2.9%, which is close to the Federal Reserve's long-run inflation target of 2%. And that was why, if you noticed, in their January meeting, the Federal Open Market Committee of the Federal Reserve, okay, decided to hold the rates at between 4.25 and 4.5 percent. So the Trump's policies, tariffs, okay, may likely again increase in inflation rates in the U.S. And if inflation rate is increasing in the U.S., what is happening? The Fed may also respond by increasing rates. And once that happens, it usually has an effect on developing economies, particularly Nigeria, where we should expect that foreign investments, particularly portfolio investments in Nigeria, may be affected, as a result of that. And some other policies, again, withdraw from the World Health Organization, stopping funding of, you said, the 90-day window. All of that also will have implications, and I want to believe that the MPC members will be taking them into cognizance when they are making their decisions, even though their decisions are, tend to be short-term, of course, because of the regularity of their meetings. But they will be taking all of that into cognizance before taking decision. But by and large, I expect that the MPC members will hold the rates, and possibly when they meet in March, because I expect them to also meet in March to be able to meet up with the calendar. They should also keep holding the rates, and before the end of the year, consider also reducing the monetary policy rates,
Prof, allow me to take it from that point where you said the inflation in the United States might one way or the other impact developing nations like Nigeria. And we just talked about an increase or a new levy or tariff from the MPA. We're hearing how this might impact inflation. Already I've spoken to business leaders who are ready to react to all of this moving forward. So do you think that with all of this, aside the fact that we are having a bit of stability in the foreign exchange market, do you think that inflation might taper down in Nigeria? It's something that we should really be clear about. The price of fuel, well, there's been that up and down thanks to deregulation. But in reality, do you think that that might have, because when we look at the figure of inflation at the moment and where the rates stand at the moment, it's still on that par.
Yeah, no doubt. Inflation is quite elevated in Nigeria, but I think the outlook for 2025, I see inflation rates, actually moderating.
Okay.
And that's moderating on the back of what the government will be doing in the area of agriculture in particular. Okay. I'm sure you all reported it recently. The president even had to increase the size of the budget, 2025, but budget from 49.7 to now 54.2 trillion. And much of that, if you look at the reasons advanced, much of that will be used to recapitalize the Bank of Agriculture and also recapitalize the Bank of Industry, as well as also diversify the solid minerals sector. So I see that as a move that will also improve productivity, improve output. By the time we'll have a stronger Bank of Agriculture, by the time we'll have a lot of money, put in the in the way of agri output, I'm pretty sure that will go a long way in reducing inflation. Because as far as I'm concerned, the major driver of inflation in this country today is the food component, is output. So once we're able to deal with that, I think inflation rates will come down. And once it begins to come down, central bank will have sufficient reason to now reverse from tightening to monetary policy easing.
All right, Professor Uwaleke, I must thank you so much, President, Capital Market Academics. I appreciate your time, always on the show, making sense of this topic ahead of the coming MPC meeting. Do have a great weekend. I see you're already prepared for the weekend, the Friday, your Friday outlook. I like your outlook today. Thank you. Our speech is so good. Thank you so much, Prof.
Tolu. Thank you.
Enjoy your weekend.
Yes. Thank you.
All right, then. Coming up on the show, we will stay with Donald Trump's policies and impact on the energy space and, of course, global markets. The Vice